In the meantime, let's welcome on board Manishi Raychaudhuri as well and find out what he's making of the market right now. Manishi, hi, good morning. Great to have you on the show. And you had great Diwali festivities.
Of course, it was a very relaxing holiday with friends here. And I wish, the team ET Now and your viewers also had a great Diwali holiday.
Yes, we all did, although we were working all through it, most of all. But Manishi, just wanted to understand, what is it that you're making of the India market construct right now? The fact that we've done so much better than what our global counterparts have done. At a time when some of the major global economies are talking about recession, India has managed to withstand not just economically, but even in terms of the market returns.
India has been an island, not just in stock market terms, but as you rightly point out, even in terms of economic growth. We think that this situation, which has actually aided the market and propelled its outperformance over the past 1 to 1.5 years, is likely to continue for the foreseeable time horizon. Indian outperformance has been catalyzed, partly by the huge concerns that we are seeing in North Asia, partly because of the recessionary concerns in the developed markets, which are clearly bringing down the export-orientated sectors, and they are the majority in this part of the world, in North Asia, and also because of some of the policy-related concerns in China. So, since these are the large components of the Asian market, I mean, if I combine China, Hong Kong, Korea, Taiwan, that's almost 70% of MSCI Asia ex Japan. They have dragged down Asian valuations as a whole. So this has been the primary support for the Indian market. Investors are forced to look at the only large market which has provided stability to returns and to corporate earnings.
So when we talk about corporate earnings, it's been mixed. Banks have done well, some of the sectors have not done that well. What is the sense that you get in terms of which sectors will lead the earnings? Banks have done well, IT saw downgrades coming in, oil has not particularly done that well. So which are the sectors you think will contribute to that earnings expectation?
I think in the near term, as far as this earnings season is concerned, you will see on a combined basis some small downgrades to, let's say, MSCI India or Nifty consensus earnings estimates. As you again rightly pointed out, banks have done well, particularly the private sector banks. And we believe that that pack would continue to do well because the credit growth is now coming back. They would also have possibly net interest margin expansion, though less than their counterparts in developed Asia. And the asset quality concerns are clearly behind us. On the other hand, if one looks at, say, consumer staples or consumer discretionaries, there could be pressure on their margins because of the input cost increases. And this is a bit paradoxical because actually industrial metals and soft commodity prices have declined. But the Indian currency has depreciated about 10 to 12%. So imported inflation of inputs would possibly feed through to margin pressure over the next couple of quarters. The other sector that could suffer in the near term could be IT because of the concerns in the US and the European region about the pressure on order inflows. But we must also point out that Indian IT services are not exactly in the same boat as the technology hardware manufacturers in North Asia, because as far as the new order inflows are concerned, we have seen significant momentum as far as the frontline IT companies go, which has provided some degree of visibility to their revenues in the medium term.
Okay, Manishi, the biggest sector which is making moves at the moment is clearly the pharma pack, and Gland Pharma has actually seen accelerated cuts. It's down 11% now. Remember, it opened with a cut of 4%, and since then we have seen a cut of 11%. But Pankaj, the rate of earnings downgrade seem to have come off. Do you think it's priced in as well? Manishi, we'll just come to you on pharma. Just wanted to take Pankaj's,
I don't really think that, it's, I mean, it's not about the rate of thing. I think it's about the PE contraction. At a point of time, it was trading very, very expensive at 4,000 and people thought nothing could go wrong. And then for 2 straight quarters, you did see earnings cut coming in and I think investors getting jittery. So I think that's the reason for this. The 1,400 was the IPO price. That itself was expensive. It opened at 2,200 and now it went to 4,000 and now it's back to about 1,969. So it's going back towards that IPO price.
Okay, so Manishi, your take when it comes to the entire pharma pack, is there any stock or, a sector or rather, let's say the theme that you like in the pharma space?
Right. I wouldn't comment on stocks individually. We have a small exposure to the pharma sector as far as our India allocation is concerned in our Asian model portfolio. We think that the pharma space, the main driver of the Indian pharma space is now the focus on the domestic market. And this is a paradigm shift that has happened over the past few years. Earlier, majority of the frontline pharma companies were all focusing on the generic market in the US. They still do, but I think the fulcrum of the focus has shifted to the domestic market. And I think one concern is possibly valuations, and that is something that the market would have to deal with.
Manishi, have we? We will connect in just a second from now with him. Metals, they are the ones which are really the shining space in the market right now. Look at the kind of spurt that you've seen on JSW Steel. And by the way, JSW Steel was, I think, one of the top winners even on Mahura Trading. Saw a nice follow through come by on Tuesday as well, and today too it's up a good 3.25%. SAIL as well is surging ahead, 2.5% higher. Hindalco, Vedanta, Nalco, the top 5 price action winners within the F&O segment are all from the metal space. Manishi is back with us. Manishi, go ahead. You were finishing your point on pharma.
All right. I was highlighting that there's a concern on valuations, and in general, when cost of capital goes up, it's the highly valued, expensive sectors that tend to suffer most. So pharmaceuticals is one sector that has suffered on that count. Consumer staples could be another one.
Sure. Manishi, you track Reliance carefully, not asking you to, comment on where the stock may be headed, but just wanted to know where could the next trigger come in from? Because this demerger recently that they announced of the financial services, that also has failed to sort of enthuse the market.
Again, I would not comment on stocks, but we think that for large conglomerates with a footprint in various different sectors, it's important to look at each of the individual businesses separately. And if one looks at telecommunication, if one looks at oil and petrochemicals, there are always some tailwinds for each of them, or even the retailing business, that some of these conglomerates are engaged in. In case of telecommunications, we are now seeing the effect of the virtual duopoly that the sector is in terms of ARPUs and margins. In case of petrochemicals or oil, even though the refining margins have contracted, they're still significantly higher than what we had over the past 2 or 3 years. I think these are some of the tailwinds that these conglomerates benefit from.
There are definitely some tailwinds that the likes of Reliance, etc. benefit from. On that note, Manishi, we'll let you go. Appreciate your time today.